Hello and welcome back. So let's take a few minutes to talk about risk and money management. And before we get into it, there are a few differences between risk and money management. So let's take a look. When we talk about risk management, we usually talk about the reward to risk ratio, the expectancy of your trading system, setup and entry quality of your trades, how this will impact your win rate, also what it means for your position sizing, stop trading techniques, how you manage your stop, and that also falls under risk management. Money management, on the other hand, focuses on position sizing based on stop loss size. So if you use a smaller stop loss, you can usually enter trades with a higher contract amount, so you can buy or sell more contracts, and that falls under money management. Also, how you scale in and out of a trade, that also falls under money management. Then there are three very important metrics every trader has to know about, and also how they can influence your risk overall as a trader and your account growth. So first of all, we start with the reward to risk ratio, which is a statistic that describes how fast your winning trades can offset your losing trades, as you will probably know by now. And the reward to risk ratio, it can be managed. You don't have full control over it. That is not necessary. We can use the reward to risk ratio as a filter tool, as we will see later, to control our risk. Position size, on the other hand, is the size of your losing trades. Of course, there are a few exceptions during slippage and other things, but you can, for the most part, manage your position size completely. Before you enter a trade, you have the power to choose how many contracts you have to buy and sell, and you can determine the risk level of your trade. Win rate, on the other hand, it cannot directly be influenced. You don't have much impact over the win rate. Over time, when you become a better trader, you might see improvements in your win rate, but at the same time, it is not important that you cannot control your win rate, because the other two metrics allow us to work on our risk management in a very effective way. So let's take a look at the reward to risk ratio first and just cover some basics. If you have a reward to risk ratio of 1:1, it means your winning trades and losing trades have the same size. On a reward to risk ratio of 2:1, that's the one I recommended so far, especially if you are starting out with this way of trading, it means that you only need one winning trade to offset two losing trades. If you are following the more advanced approach where you let your winning trades run, and then sometimes you can get a reward to risk ratio of 8:1, sometimes 10:1 or even higher, and it means your winning trades are 8 times the size of your losers. You only need one winning trade for every 8 losing trades. So let's see how this connects to required win rate and to win rate overall. If you are trading with an average reward to risk ratio of 1:1, your winning trades and losing trades have the same size, then you need at least a win rate of 50% to break even, because if you have one winning trade and one losing trade, they more or less cancel each other out. So you need a win rate of higher than 50% to trade profitably. If you, on the other hand, have a reward to risk ratio on average about 2:1, your winning trades are twice as large as your losers. It means that out of every 3 trades, you only need to have one winning trade to break even. So this means you can trade with a win rate of 33% break even, and if your win rate is higher than 33%, you can potentially make profits. So that sounds very reasonable and very realistic to trade with a win rate of 33%. So you can see how choosing the reward to risk ratio on your trades is very important for the outlook of your system. Let's take a look at the 8:1 reward to risk ratio, where your winning trades are 8 times the size of your losses. So out of every 9 trades, you only need one winning trade to break even, which means you only need a win rate of 11%, and that should be quite obtainable. Although it can be more hard on the emotions, as I said before, when you have long periods of losses and you just need one winning trade to break even, it is not generally recommended for the beginning trader, but that is a different story. So as I said, you cannot fully control your reward to risk ratio, but we use the reward to risk ratio as a filter for our trades. So before we get into a trade, we very objectively analyze, do we have a large profit potential? Can we put our stop loss in a place where it allows us to make a good profit? And we filter out the trades where we don't have a good enough reward to risk ratio, and we only take the trades where we at least have a reward to risk ratio of 2:1 when we enter the trade. And preferably you want to have a reward to risk ratio initially that is much higher than 2:1. At the bottom, I highlighted it again. You have to be very realistic with your order placement. Don't adjust your orders. So this means that many traders will choose a smaller stop loss just because they want to have a higher reward to risk ratio. But trading does not work this way, and that has to be avoided at all costs. Always look for reasonable stop and take profit levels, and then see if it fits your reward to risk ratio criteria. When it comes to position size, there are a few rules, and as an absolute maximum, you should risk 3% per trade of your whole account. So if you have a $10,000 account, don't risk more than $300 on one trade, although this is a very high number, and for beginners this should be much less. So the standard position size should be roughly 1 to 1.5%. If you want to go lower, there's nothing wrong with that. And in the next video, I will take a look at realistic expectations and what this will mean for the long-term expectancy. So if you are just starting out, you're a beginner, don't go over 1% per trade and only risk 1% per trade. So here we can take a look at drawdowns and recovery rate quickly, that we can understand why position sizing is so important. So let's say you are in a 5% drawdown, you lost 5% of your account, and you have to recover 5.3% then. It will become much clearer what this is when we take another look at a 50% drawdown. So let's say you had a $10,000 account, you lost half of it, you are down to $5,000, and to get back to the $10,000, you now have to double your account. And doubling means that you have to get a 100% return. If you want to recover from a 50% drawdown, you have to make a 100% return. So it is very important that you don't get into large drawdowns. Especially you have to manage your emotions, analyze your trading, and make sure that you are always respecting the rules, because getting out of a large drawdown is very hard. And then before we get into our simulation, we have to talk about variance and uncertainty. And most traders are in a short-term mindset where they just think on a trade-to-trade basis. But it is very important in trading that you are in a long-term mindset where you know that over the long term your statistics will play out. It is not important what your next 1, 2, 3, even 5 trades will be, and you cannot control that. And variance means that anything can happen over the short term. Even though with a good system you might have 5 or sometimes 6, 7, 8 losing trades in a row, but if you follow the rules, if you choose trades with a large enough reward to risk ratio, and if you stick to the plans, then over the long term you will most likely end up ahead if you have a good system. So be aware of variance and also uncertainty. One trade does not mean anything in your trading. If you are in this for the long term, you will take hundreds and sometimes thousands of trades. So don't let one bad trade have a big impact on your account, and accept that over the short term anything is possible, but as long as you stick to the plan and make good trades, over the long term things will play out. So now let's explore what is long-term thinking and variance really in trading, and how the reward to risk ratio fits in. So we are here on the Edgewonk simulator. Edgewonk is the trading journal that we have built on Tradeciety, and you can get the link below for that. You can try it out, and we highly recommend that you also look into trading journaling, and we will get into this into a later video. But for now we are here in the simulator, and you can see that there's happening a performance simulation. Each graph visualizes a different outcome that is based on the key statistics here. So the win rate of 64%, and you can see here the reward to risk ratio is 1 to 1. And so you can see if we start the simulation, there are pretty big variances, large drawdowns here. The graphs are very far away from each other, which means that the further away the graphs are, the higher the uncertainty, the higher the volatility is. So you can see with the reward to risk ratio of 1 to 1, although the growth looks good overall, it is going to the right top corner, which is usually what we all want. There are a lot of short-term volatility, and there's a lot of short-term uncertainty, which can cause a lot of problems. So let's see if we increase our reward to risk ratio to 1.5. Everything else stays the same. You can see already that the account growth has changed a lot. So if we just filter out the trades that have a low reward to risk ratio, and we only focus on the trades where you can reasonably expect to have a large or a large enough reward to risk ratio, then this is going to increase your profitability probably in a very big way. So that's why I highlighted in the last video why staying away from trades with a low reward to risk ratio is usually a good idea. So let's see if we increase the reward to risk ratio and we even decrease our win rate to only 55%, and you can see again that even with a lower win rate of only 55% and with a reward to risk ratio of 2:1, you can see the account growth is accelerating a lot. So we don't need a high win rate, you only need to be right. Even when we reduce it to 50%, you only need to be right in half of the time, in half of your trades. If your reward to risk ratio is large enough, you will have a good account growth usually. There are moderate swings in there, but as you can see, even with a very small win rate, you will usually be fine over the long term. So that is how you can understand how win rate and reward to risk ratio play out over the long term, and why you should always skip trades with a low reward to risk ratio, and what this means for your overall long-term account growth. Again, if you want to play around with it, there's a link in the description below this video. You can try and download Edgewonk for free. In the free version, you have full access to the simulator as well. And so just try to familiarize yourself with it, play around with the metrics here a little bit to understand what happens if you change the reward to risk ratio, and what it means and how win rate impacts your account growth, and then you get a better understanding of variance and those metrics in your trading. Thank you for watching, and see you in the next one.